Next topic I want to move on to is evidence-based investing. That was episode 22 with John Stocking, who did a really good job. So, John, if you are listening, thank you so much. And we talked about one concept in that episode, the topic of uncorrelated returns. And so I want to dive into this topic of correlation a little bit further. But essentially, a paper published by Vanguard in 2012 that I'm going to share here. It is called Dynamic Correlations and the Implications for Portfolio Construction. So, what is correlation? Well, when two different asset classes are positively correlated with each other, they will tend to move in the same direction. They may not move in the same direction by the same amount, but generally they will move in the same direction. Whereas if you have two asset classes that are relatively uncorrelated with each other, they won't follow each other that much. They may still move at time in the same direction, but certainly not by the same amount. And at certain times, particularly in times of market stress, these asset classes can move in different directions. So let's go and take a look at a few figures from this paper. One thing to just drive home is that when you are investing in two asset classes and they are relatively uncorrelated, that can in fact help to reduce volatility in your portfolio, but you may not be compromising on returns that much. And that's shown in figure 1 of this paper, which will also be in the show notes. You can see here on the y-axis, you have annual return and volatility as a percentage. The dark bar is volatility, and the blue bar is your return. On the x-axis, you have portfolio composition. So on the left here, let's look at the portfolio that is 100% stock, 0% bonds, versus 90% stock and 10% bonds. Well, you can see that by introducing just 10% bonds, you're reducing the volatility of your portfolio quite a bit more than the compromise on returns. So the relative reduction in volatility is about 10%, whereas the absolute reduction in returns in this case was 10.15% for a 100% stock portfolio to 9.97% for a portfolio composed of 90% stocks and 10% bonds. That's concept 1. Uncorrelated assets can help to reduce volatility. Point number 2 that I want to make is shown in figure 2. Correlation is best measured over a long time frame. And this picture shows the average correlation between US stocks and US Treasury bonds from 1926 all the way until 2012. You can see that the average correlation is marked by this blue line. It's 0.25. So these are not highly correlated assets. But if you narrow in on shorter windows of time, so if you look at the 1930s and if you look at the 1970s, US stocks and US bonds in those short time frames, they tended to move together. So the point here is that in a short time frame, you may not see your typical level of correlation between two asset classes. One important thing I will point out is US stocks and US bonds tended to move together. They were quite correlated in the mid 1970s. We know that was a decade that was rampant with inflation, and who knows if we're going to experience more of that now. Inflation certainly is high. But there is an interesting article here published by Ilmanen in 2003 that found that in times of inflation, US bonds and US stocks did tend to move together quite a bit more. So that's something that's interesting to note. And the final figure that I want to show you is figure number 8. And this basically examines the time frame from October 2007 until December 2011. So the great financial crisis and some of the following recovery. And it looks at the bad days where the US stock market fell anywhere from 4% to 9% on a single day. And then it examines how different asset classes moved in relation to US stocks. So if you look at real estate investment trusts, also known as REITs, if we look at days where the US stock market fell 9%, well, there were days when REITs actually fell 12% or 18%, even more than stocks. And if we go here, where the US stock market fell about 7%, we saw that REITs also fell 7%. So kind of moving in tandem with US stocks. Now, it's interesting to note that the only asset class here, truly speaking, that was almost always uncorrelated with US stocks in times of market crisis was US Treasury bonds. And they basically remained neutral, not falling on these bad days when the US stock market was nosediving. So, something to keep in mind. Now, what does this mean practically for all of us? So, if you have a long investment horizon, I'm talking decades down the road, and you are relatively loss averse, meaning that drops in your portfolio are not going to impact you and you're still going to be sleeping at night, then it's probably very reasonable for you to stick with a 100% stock portfolio if you can stomach those losses. Now, in contrast, if you are the type of person who is loss averse, I am somewhat loss averse, and if you feel like big losses are going to cause you butterflies in your stomach, if you feel like big losses are going to cause you to perhaps deviate from your strategy, then you may want to rethink 100% stock portfolio allocation. Now, John Stocking made a really critical point in the episode, which I encourage everybody to go back and listen to, episode 22. And he mentioned that uncorrelated returns can become critical when someone is nearing retirement or in retirement. And that's something that I fully agree with.